You swipe a credit card to buy lunch. $15, you'll pay it off next month. No big deal. Then you use it for gas. Then groceries. Then an emergency car repair you can't afford from your paycheck. The balance grows. $100, $500, $1,000. And here's where the trap closes. You're paying the minimum each month. $50, maybe $70. You think you're handling it. But every month, interest is being added to your balance. 24% annual percentage rate, compounding daily. That $1,000 balance isn't shrinking, it's growing, even though you're making payments, even though you've stopped using the card. The math is designed so that minimum payments barely cover the interest. The principle stays almost unchanged. If you have $5,000 in credit card debt at 24% interest, and you pay only the minimum, it will take you over 20 years to pay off. You'll pay over $10,000 in interest, double what you borrowed. And that's if you never miss a payment, never use the card again, never get hit with late fees or over-limit fees. The credit card companies know this. They designed it this way. They don't want you to pay off your balance quickly. They want you to carry a balance forever, paying interest, generating profit. You're not a customer, you're an asset, a revenue stream, and the system is built to keep you trapped in debt for as long as possible. In the next 10 minutes, I'm going to show you exactly how the credit card trap works, why banks engineered it this way, how much profit they extract from people who can barely afford to make minimum payments, and why this is one of the clearest examples of how modern empire economies extract wealth from ordinary people through legal mechanisms that would have been called usury and been banned in earlier eras. Because credit card debt is not just a personal finance problem. It's a systematic wealth extraction system, and understanding how it works is understanding how late-stage empires monetize the desperation of their citizens. Let's start with how we got here, because credit cards haven't always existed. Before the 1950s, most consumer purchases were cash or installment plans with specific merchants. You'd buy furniture on an installment plan with the furniture store, or you'd have a tab at the local grocer that you settled monthly. These were personal relationships with specific terms. Then, in 1950, Diners Club introduced the first universal credit card. You could use it at multiple merchants. American Express followed. Then in 1958, Bank of America launched Bank AmeriCard, which later became Visa. This was different. This was bank-issued credit that could be used anywhere. At first, these cards were for the wealthy, convenience tools. You'd charge purchases and pay the full balance at the end of the month. No interest if you paid in full. Essentially a short-term loan for convenience. But banks realized there was more money to be made. If people carried balances instead of paying in full, banks could charge interest. So they started marketing cards to the middle class, to people who might not pay in full every month. And they discovered something profitable. Many people would carry balances, would pay interest, month after month, year after year. This was a goldmine. And here's the key part. The interest rates were high, much higher than other forms of credit. A mortgage might be 6%, a car loan 8%, but a credit card 18%, 24%, 24%, even higher. Why could they charge so much? Because credit card debt is unsecured. There's no collateral. If you don't pay your mortgage, the bank takes your house. If you don't pay your car loan, they repossess the car. But if you don't pay your credit card, there's nothing to take. So banks charge higher interest to compensate for higher risk. But here's what makes it exploitative. The people most likely to carry balances are the people who can least afford the interest. The wealthy pay off their cards in full every month. They earn rewards points. They pay zero interest. They actually profit from credit cards. The poor and middle class carry balances. They pay interest. They pay late fees. They subsidize the rewards programs that benefit the wealthy. This is wealth transfer from those who can least afford it to those who need it least. And it's by design. Banks actively target people who will carry balances. They send pre-approved offers to people with low incomes and poor credit. These people are risky borrowers, but they're profitable because they pay high interest for years. Banks call these customers revolvers. People who revolve a balance month to month. These are the profitable customers. The people who pay in full are called deadbeats in internal bank documents, because they don't generate interest revenue. Think about that. The responsible customers are called deadbeats. The people trapped in debt are the valuable ones. This tells you everything about how the system is designed. Now let's talk about minimum payments, because this is the core of the trap. When you get a credit card bill, it shows a minimum payment, usually about 2 to 3% of the balance. On a $5,000 balance, that's $100 to $150. Sounds manageable. You pay it, your current account is in good standing. But here's the trap. That minimum payment barely exceeds the interest charge. At 24% annual interest, you're accruing 2% per month in interest. That's $100 per month on a $5,000 balance. If you pay the $150 minimum, only $50 goes to principal. Let's do the math to show how profitable this is for banks. A customer with $5,000 in credit card debt at 24% interest paying only minimums will pay that debt for 23 years. They'll pay about $10,000 in interest. The bank loaned them $5,000 and gets back $15,000. That's a 200% return. And that's one customer. Banks have millions of customers carrying balances. The total outstanding credit card debt in America is over $1 trillion. At an average interest rate around 20%. Banks are collecting over $200 billion per year in interest. This is pure profit. The money was created when the loan was made. Banks don't actually have the money they lend. They create it through fractional reserve banking. So they created money out of nothing, lent it to you, and now you're paying back double in real dollars you earned through labor. This is wealth extraction on a massive scale. Now let's talk about the psychological and legal tricks banks use to keep you trapped. First, the minimum payment framing. By telling you what the minimum is, they anchor your payment to that number. Most people pay the minimum or slightly above. They don't realize they should be paying much more. The minimum becomes the default. Second, rewards programs. Cashback points, travel miles. These make you feel like you're winning, but rewards are funded by interest and fees paid by people carrying balances. If you carry a balance, your interest payments far exceed any rewards you earn. You're losing. But the rewards make you feel like you're gaining. Third, low introductory rates. 0% for 12 months. Sounds great. But most people don't pay off the balance during the promotional period. When it ends, the rate jumps to 24%. And any remaining balance now accrues interest at that rate. The promotional rate is bait. Fourth, complexity. Credit card terms are deliberately confusing. Pages of fine print. Variable rates. Different rates for purchases, cash advances, and balance transfers. Penalty rates if you're late. Most people don't understand what they're agreeing to, and banks like it that way. Confusion benefits the institution. Fifth, late fees and penalties. Miss a payment by 1 day and you're hit with a late fee, $35, plus your interest rate might jump to a penalty rate of 29%. These fees are designed to extract maximum money from people who are already struggling. You're more likely to miss a payment if you're broke, and that's when they hit you hardest. Now, let's talk about usury laws because credit card interest rates used to be illegal. Usury is charging excessive interest on loans. Throughout history, societies have banned or limited usury as immoral and economically destructive. The Bible forbids it. The Quran forbids it. Medieval Catholic Church forbade it. Charging interest was seen as exploiting the desperate, profiting from others' misfortune, and societies recognized that high-interest debt traps people in poverty. If all your income goes to interest payments, you can never escape. You're a debt slave. So societies limited interest rates. In the United States, there were state usury laws capping interest rates, often at 6 to 10%. But in 1978, the Supreme Court ruled in Marquette National Bank v. First of Omaha that banks could charge the interest rate legal in the state where the bank is located, regardless of where the borrower lives. This is called interest rate exportation. Banks immediately moved to states with no usury caps, South Dakota, Delaware, and they started charging whatever they wanted. 20%, 25%, 30%, the caps were gone, and credit card interest rates exploded. This was deregulation that directly harmed consumers and enriched banks, and it was sold as increasing competition and access to credit. But what it actually did was eliminate protections against predatory lending. Let's connect this to the empire pattern because debt servitude is a classic feature of declining empires. In healthy economies, debt is used productively. You borrow to buy a house that appreciates, to fund education that increases earnings, to start a business that generates income. The debt creates value. But in declining economies, debt becomes extractive. You borrow for consumption, for necessities you can't afford. Medical bills, car repairs, groceries. The debt doesn't create value. It just transfers wealth from you to creditors. This is what's happening now. 60% of Americans carry credit card debt. The average balance is over $6,000. People are using credit cards not for convenience but for survival. They can't afford basic expenses, so they charge them, and then they're trapped, paying interest forever. Never escaping this is debt servitude. You're not legally a slave, but economically you are. You work to pay interest to banks. Your labor enriches creditors. You can never build wealth because all your excess income goes to interest payments. This is how late-stage empires extract wealth from citizens, not through direct taxation, which would be visible and resisted, but through debt. Make people borrow for necessities, charge high interest, trap them in perpetual debt, extract wealth through interest payments. It's efficient, it's legal, and it's devastating to individuals and society. Now let us talk about what you can do, because understanding the trap is the first step to escaping it. If you have credit card debt, your priority should be paying it off as fast as possible, not the minimum. As much as you can. Cut expenses, increase income, throw everything at the debt. The interest rate is so high that paying off credit card debt is the best investment you can make. Better than the stock market. Better than anything. If you're paying 24% interest, every dollar you pay toward the balance saves you 24 cents per year. Guaranteed return. That's unbeatable. Use the avalanche method. Pay off the highest interest rate card first, then move to the next. Or use the snowball method. Pay off the smallest balance first. Get a psychological win, then move to the next. Either way, the key is intensity. This is an emergency. Treat it like one. If you can't pay off the debt quickly, consider balance transfer cards. Some offer 0% interest for 12 to 18 months. Transfer your balance. Pay it off during the promotional period. But be disciplined. If you don't pay it off, you're back to high interest. Also consider credit counseling. Non-profit organizations can help negotiate lower interest rates with your creditors. They consolidate your payments into one. You pay the counseling organization, they distribute to creditors. Not all are legitimate. Research carefully. Avoid for-profit debt consolidation companies. Many are scams. The bigger lesson is to avoid credit card debt in the future. Use credit cards only if you pay the full balance every month. If you can't do that, don't use credit cards. Use debit, use cash. Live within your means. I know that sounds harsh, when wages are stagnant and costs are high, but credit card debt makes your situation worse, not better. It feels like it helps in the short term, but it traps you in the long term. The system is designed to trap you. Banks spend billions on marketing to make you use credit cards. They want you in debt, because that's how they profit. Resist. Be disciplined. Build an emergency fund so unexpected expenses don't force you into debt. This is hard. It requires sacrifice, but it's the only way to escape the trap. The alternative is decades of interest payments. Decades of working to enrich banks. Decades of debt servitude. That's not living. That's surviving. And you deserve better. This is the credit card trap. Banks designed a system that extracts maximum wealth from people who can least afford it. High interest rates that used to be illegal. Minimum payments that keep you in debt for decades. Psychological tricks that make you feel like you're in control when you're not. Legal changes that removed protections and enabled predatory lending. And an entire economy that forces people to use credit for basic necessities. This isn't about personal responsibility. Yes, people choose to use credit cards, but the system is designed to exploit that choice, to profit from desperation, to trap people in debt. This is how modern empires extract wealth, through legal mechanisms that look like free choice but function as wealth transfers from the poor to the rich. The credit card trap is one of the clearest examples. Banks profit, consumers suffer, and the empire economy continues its extraction. This is the empire economy, where we decode the systems that concentrate wealth and power. The credit card trap reveals how it works at the individual level. Banks want you in debt forever, because that's how they make money. Understanding this is the only defense. Knowledge won't pay off your debt, but it will stop you from falling deeper into the trap. If you found this valuable, subscribe, because the systems that extract your wealth operate in the shadows. We bring them into the light. The credit card trap is just one. There are many others, and seeing them clearly is the first step to protecting yourself.